The breakout that took your money. You've had this trade. Price grinds under a level for hours. Finally cracks it. You buy the breakout, and 40 minutes later you're stopped out while price sits back inside the range like nothing happened. That's not bad luck. That's a fake out, and it has a signature you can learn to read. Here's the uncomfortable truth about breakout trading. The entry is the easy part. Anyone can see a level break. What separates traders who make money on breakouts from traders who fund them is the 20 seconds of checking they do before they click. So in this video, I'm giving you a 4-point filter that every breakout has to pass before I'll take it. Then I'll show you 2 full examples, one clean break I'd take and one textbook fake out I'd fade, and I'll show you how to trade the failure, because a failed breakout is often the better trade of the two. What you're getting in the next 20 minutes. Quick roadmap. First, what a breakout actually is, because most people are trading a line, not a level. Then, why fakeouts exist at all, and once you see the mechanism, you stop taking them personally. Then, the 4 filters, one by one, with a chart for each. Stay to the second example, because that's the one where I show you the entry that turns a losing breakout into a winning reversal. It's the same chart, the same level just read from the other side. Most traders never learn it, which is exactly why it keeps working. And one framing point before we start. Breakouts feel exciting because they're fast, and fast is exactly what makes them dangerous. Excitement is not an edge. Everything in this video is designed to slow you down by about 30 seconds, which, on a breakout, is the difference between the entry and the exit, liquidity. A breakout is not a line being crossed. Let's define it properly. A breakout is price leaving a defined area of balance with genuine momentum and then accepting the new price outside it. 3 parts: defined area, momentum, acceptance. Miss any one of them, and what you've got is a candle poking through a line you drew. That word acceptance is doing a lot of work. A breakout isn't confirmed by price touching a level on the other side. It's confirmed by price staying there. On an hourly chart, I want to see the market comfortably trading above old resistance for a couple of candles, not one spike and an immediate retreat. And the area itself has to be worth something. A level that price has tested 3 or 4 times and defended each time is a real decision point. There are orders sitting there, and everyone can see it. A level you drew off one random wick 3 weeks ago is a doodle. It breaks constantly because nobody is defending it. So, before anything else, I ask one question. Would a large participant care about this level? If the answer is no, there's no trade here, no matter how nice the candle looks. Breakouts only pay when there's something on the other side worth breaking into. Why fakeouts exist, and why they're not personal. Now, the mechanism, because once you understand it, half the frustration disappears. Look at where every breakout trader's stop loss goes. Long the break of resistance, stop just under the level. Short the break of support, stop just above it. Thousands of traders, same logic, same few pips. That's a pool of orders in a known location. And above the range high sits a second pool, the stops of everyone who sold the range top. So an obvious range has fuel stacked on both sides of it. That isn't a conspiracy, it's just the arithmetic of everybody being taught the same entry. So a fakeout is usually just a large order filling itself. To buy size, someone needs sellers. Pushing price above the range high triggers buy stops and pulls in breakout buyers, and both of those give the seller exactly the counterparty they need. Once they're filled, the push has no reason to continue, and price falls back inside. which gives you a very useful reframe. The fakeout isn't the market cheating. It's the market showing you where the real orders were. A break that immediately fails is information it tells you the sellers above that level were bigger than the buyers who chased it. Trade that information instead of complaining about it. Filter 1 is the range even worth trading out of. Filter 1 is about the setup before the break. The best breakouts come out of compression price, getting tighter and tighter until it has nowhere left to go. That's why triangles, flags, and tight ranges work. They're a visual record of a market running out of room. Practical version. Measure the range. If the last 20 candles cover less ground than the 20 before them, you have compression. If the range is expanding, price already has room to move, and a break of the edge means far less you're joining a move that's already had its acceleration. The second half of this filter is the touch count. I want the level tested at least twice, ideally 3 times. With rejections you can actually see. Each touch adds orders. Each rejection adds stops above. By the third test, the level is loaded, and loaded levels are the ones that produce real expansion when they finally go. What I'm not looking for is a level in the middle of nowhere on a chart that's already trending hard. Price cutting through a random hourly high inside a strong move isn't a breakout, it's just a trend continuing. And you're paying breakout prices for a continuation entry. Filter 2. Read the breakout candle, not the alert. Filter 2 is the candle itself, and this is where most of the damage gets done. A breakout candle has to do 2 things: expand and close well. Expansion means it's meaningfully bigger than the candles that came before it. I want at least double the recent average, and I'm much happier at 3 times. Closing well means the close sits in the top third of the candle's own range for a bullish break, or the bottom third for a bearish one. Here's a quick test you can do in your head. If the wick beyond the level is longer than the body, the market rejected the new price. That candle isn't a breakout. That candle is the first half of a fakeout. And the close has to be beyond the level, not at it. A candle that closes 1 or 2 pips through resistance hasn't proved anything. It's still inside the noise band of that level. On GBP/USD, I want a clear buffer beyond the line. On gold, several dollars. The exact number depends on the instrument's normal noise, which you should know before you trade it. One more thing that saves a lot of trades. Wait for the candle to actually close. Watching a 15-minute candle break a level with 9 minutes to go and clicking immediately is not trading the setup. It's trading a candle that doesn't exist yet. More than half of them come back before they close. I filter 3 participation and the forex volume trap. Filter 3 is participation. Did anyone actually turn up for this move? On stocks and crypto, that's easy because you have real traded volume, and a genuine break usually arrives with a volume bar noticeably taller than the ones before it. Not a record just clearly above the recent average. Now the part almost nobody tells you, and it matters if you trade forex. There is no central exchange for spot FX, so the volume on your chart is not real volume. It's tick volume account of how many times the price updated. It's a proxy for activity, and it's a decent one, but it is not the number of contracts traded. So use it comparatively, never absolutely. I'm not asking whether the bar is big. I'm asking whether it's bigger than the last 20 bars at the same time of day, because a 9 in the morning bar and a 2 in the afternoon bar are not the same animal. Compare like with like, or the signal is meaningless. And if your platform's volume data is unreliable, use the substitute, range. Participation shows up as candle range, whether you can measure volume or not. If the breakout candle and the two after it are all wider than average, people turned up. If they immediately shrink back to normal size, they didn't. Filter 4. Timing beats technique. Filter 4 is context, and it's the one that separates a chart reader from a trader. The same breakout at 8 in the morning UK time and at 4 in the afternoon has completely different odds because the participants are different. Breaks of the overnight range at the London Open or during the London to New York overlap come with real order flow behind them. Breaks in the quiet hours are frequently just noise finding the edge of a thin book, and thin books produce exactly the spike and return pattern you're trying to avoid. The other half of context is the calendar. A breakout 30 seconds before an inflation print or a central bank decision isn't a setup. It's a coin toss with a widened spread. Check the calendar before you plan the trade, not after you're in it and wondering why price just moved 80 pips sideways through your stop. There's a nuance worth knowing, though. News can also be the reason a good breakout works a level that's been holding for 2 days, often gives way precisely because a data release changed the story. The rule isn't to avoid news. It's to never be in the trade during the release and to let the first post-news candle close before you decide anything. Quick pause. If the filters are making sense so far, a like helps this reach the traders still buying every candle that pokes through a line. Right. Let's talk about entries. 2 ways in. Break and go or wait for the retest. There are 2 legitimate entries, and they suit different people, so let's be honest about both. Entry 1. Break and go. You enter on the close of the breakout candle. You get the whole move, you never missed a trade, and you pay for that with a wider stop and a worse average price. Entry 2. The retest. You let price break, then wait for it to come back and hold the old resistance as new support. Your stop is far tighter, your reward to risk is much better, and you have proof the level flipped. The cost is that a strong breakout often never retests, and you watch the whole move from the sidelines. The mistake is trying to have both waiting for a retest, not getting one, then chasing the move 40 pips higher with the original stop still in your head. That's how a good plan becomes a 2% loss. Decide which trader you are before the level breaks, not during. If you want a rule of thumb, take the break and go when the candle is genuinely explosive and out of a long compression, because those rarely give you a second chance. Wait for the retest when the break is decent but not violent. That's when price usually comes back to check the level before continuing. Stops, targets, and the measured move. Stops first. For a break and go entry, the stop goes back inside the range below the last higher low of the pattern for a long, not 1 pip under the level. If you tuck it right under the line, you've put it exactly where every other breakout trader's stop is, which is the cheapest liquidity on the chart. For a retest entry, the stop goes below the rejection candle that confirmed the flip, plus a buffer for spread. That's usually a much smaller distance, which is the whole appeal of waiting same target, less risk, bigger multiple. Now, targets. And this is where the measured move earns its keep. Take the height of the pattern, the vertical distance from the top of the range to the bottom, and project it from the breakout point. It isn't magic. It's a reasonable estimate of how much energy the compression stored. It gives you a target that exists before you enter, which is the point. I'd add one adjustment. If there is an obvious swing high or an old level sitting just before your measured target, take profit there instead. Never plan to trade through an obstacle for the last few pips. Getting 80% of the move consistently beats getting 100% occasionally. Sizing. Quickly. because it's the part that decides whether any of this survives a losing streak. Work out your stop distance first, then size, so that distance costs you 1% of the account. On a 50 pip stop with a 10,000 pound account, 1% is 100 pounds, which is about 2 pounds a pip, roughly a fifth of a standard lot on a dollar-quoted pair. Example 1. The clean break on GBP USD. Let's put it together. Illustrative levels around where cable is trading now, so follow the structure rather than memorizing the numbers. Over 3 sessions, price has been capped at 1.3500, testing it 3 times, while the lows have crept up from 1.339 to 1.344. That's an ascending triangle. Flat top, rising floor. Filter 1 passes easily. 3 touches of the same ceiling, higher lows squeezing into it, and the range of the last 20 candles is roughly half the range of the 20 before. This market is compressed and is running out of room. That's the setup I want before I care about any candle. At the London Open, the hourly candle takes out 1.3500 and closes at 1.3538. Filter 2. That candle is about 3 times the size of the recent average. The body is fat, and the close sits in the top quarter of its range with only a small upper wick. That is acceptance, not a poke. Filter 3. Tick volume on that candle is well above the 20-period average, and crucially, the next 2 candles stay wide rather than shrinking. People turned up and stayed. Filter 4. It happened at the London Open with no high-impact data in the next 2 hours. All 4 pass. The trade. Because the candle is explosive out of a long compression, I take the break and go at 1.3540. Stop goes under the last higher low at 1.348258 pips, safely back inside the pattern. The triangle is 110 pips tall, so the measured target is 1.3610. That's roughly 1 to 1.2, which isn't spectacular, so here's the adjustment. I take half off at 1.3580, move the stop to entry, and let the rest run to the measured target. Same setup, but now a losing outcome is a scratch, and a winning outcome still pays properly. Example 2, the fake out, and how to trade it. Now the failure. And pay attention, because this is the more valuable pattern. Gold has been ranging under 4,110 for most of the session, with 2 clean rejections from that ceiling, and a floor around 4,070. Then it breaks. Price pushes to 4,118, and for about 10 minutes everything looks perfect, but run the filters. The candle has a long upper wick and closes at 4,111, $1 above the ceiling. The close is in the bottom half of its own range. Filter 2 fails immediately. Filter 3 fails too. Volume on the break is about average, and the following candle shrinks. And filter 4 is the giveaway it happened in the dead zone between the London close and the New York afternoon, when the book is thin. 3 of 4 filters failed. That's not a trade I take, and now it's a trade I take in the other direction. Here's the reversal setup. The trigger is price closing back inside the range below 4,110. That close tells you the breakout buyers are trapped above the level with losing positions, and their stops are now sitting just above 4,118, which is fuel for the move down. So I short at 4,106 on that close back inside. Stop at 4,121, just above the fake-out wick, $15. Target is the opposite side of the range at $4,070, $36 away. Better than 2 to 1 on a level everyone else just got trapped at. That's the whole reframe of this video. You don't need to catch every breakout. You need to categorize them. And the ones that fail your filters aren't wasted analysis. They're the setup for the opposite trade. Same chart, same 20 seconds of work, two different opportunities. The psychology bit where the filters actually break. Let's be realistic. You already knew half of this. The filters aren't hard. What's hard is applying them at 9 in the morning when price is ripping through a level and every part of you is convinced you're about to miss the move of the week. So write the plan before the break. Level, direction, which entry you're taking, the stop, the target, the size. 6 items, 30 seconds, done while you're calm. If the breakout arrives and it doesn't match what you wrote, you don't take it, and you'll be amazed how often the ones that don't match are the ones that fail. Second thing, accept that you will still get faked out. Even a 4-filter breakout fails sometimes because you're trading probabilities, not certainties. A trader who expects to be right every time will widen a stop to avoid being wrong, and widening stops is how small losses become account-sized ones. Third, stop counting individual trades. Judge the filters over 30 setups, not 3. 3 trades tells you about variance. 30 tells you whether the process works, and only one of those 2 numbers is worth changing your strategy over. Your drill this week: score 20 breakouts. Here's the homework, and it costs you nothing. Open your charts. Go back over the last month on 2 instruments you actually trade and find 20 breakouts. Don't trade them. Score them. Give each one a mark out of 4 1 point per filter passed. Then write down what happened next. Did it run? Or did it come back inside within 3 candles? After 20, you'll have your own data on how much each filter is actually worth on your instruments, which is far more convincing than me telling you. I'll tell you what most people find when they do this. The 4 out of 4 breaks are rare and mostly work. The 2 out of 4 breaks are everywhere and mostly fail. And almost everyone discovers they've spent the last year trading 2s. Recap and what to do next. 5 lines to take away. 1. A breakout is a defined area, momentum, and acceptance, all 3. Or it's just a candle crossing a line. 2. The level must be worth breaking. Test it 2 or 3 times out of genuine compression. 3. The candle must expand and close well beyond the level, and you wait for it to close. 4. Participation has to show up volume above its own average, or at minimum, candle ranges that stay wide afterwards. 5. Timing matters more than technique, so trade the open and the overlap, and stay flat through data. And the sentence I'd keep: a breakout you have to talk yourself into is a fake out you haven't recognized yet. If it needs an argument, it's a 2 out of 4. Let it go. There's another level forming right now on some chart you're already watching. If this changed how you'll look at the next breakout, subscribe and turn on the bell. The next breakdown goes deeper on trading the retest entry properly, including where the flip actually confirms. And tell me in the comments, are you a break-and-go trader or a retest trader? I read them all. Not financial advice. Trading carries risk. Manage your risk, 1 to 2% per trade. Thanks for watching, and I'll see you in the next one.